Hello and welcome to CMC Markets on Tuesday the 19th of November and the weekly market update. Now it's been a couple of weeks since I last did one of these, and to be honest quite a lot has happened since then. We've seen an ECB rate cut. We've also seen a continued deterioration in European economic data. Now the GDP numbers that we saw last week pointed to a little bit of a slowdown from the fairly good Q2 numbers that we saw earlier this year. France's GDP in particular went back into contraction again, and Germany's GDP numbers came down from 0.7 to 0.3. But I think more concerning than that really has been the continued rise in EU unemployment to 12.2%, Italian unemployment to 12.5%, and I think a distinct lack of acknowledgement that even though we've had an ECB rate cut, it's not really going to address the underlying problems within the euro area. Despite all of this, European markets continue to push higher. The DAX is once again at record highs. The S&P 500 is once again at record highs, as is the Dow Jones. The S&P is pushed above 1800. The Dow Jones has pushed above 16,000. And the DAX is pushed above 9,200. But you do get, or at least I get, the distinct impression that an awful lot of these gains are very much overcooked. And Matt Bassey and myself were having a rather animated debate this morning about whether or not the gains that we're currently seeing in equity markets are really justified by valuations. And he was arguing that essentially they are justified by valuations because they're pretty much in line with average PE ratios from the past. I, however, am arguing that really they're overextended. And if you look at the reaction that we saw from some fairly innocuous comments from billionaire investor Carl Icahn last night, you have to ask yourself as to whether or not how convinced investors are at the moment that these gains are in any way sustainable. So let's talk about the Fed, because I think investors are looking less at the economic data and economic fundamentals and more at whether or not the Fed is going to taper or not at its December meeting. And I think that is really what's behind the current rise that we're seeing in equity markets. It's not about the fundamentals. It's not about the economic data. It's all about market expectations of whether or not the Fed is going to continue at its current rate of asset purchases of $85 billion a month. And anything else is just fluff, it's just noise. Now, if we look at a chart, and I think this is very important because I think this sort of really feeds into my argument that we are getting into very overextended territory. I'm going to look and I'm going to show you guys a chart, a long-term chart, a weekly chart of the S&P 500 and the DAX in relation to their 200-week moving averages. And you can make your own conclusions as to whether or not we're overextended. So let's start with the S&P 500 weekly chart. Now this is a weekly chart for the last 10 or so years. It's a simple line chart, it's fairly straightforward, and underneath price action or around the price action, we've got the 200-week moving average. And you can see straight away from this chart that the price action has never in the last 10 years been this far away from the 200-week moving average. The closest we actually came to being this far away was in 2007 prior to the big drop lower. So that gives you an indication of why I think the S&P 500, this current up move, is significantly overextended. The only concern is there's no real accurate way you can actually gauge when the top is in. So now I'm going to show you a different chart. Well, actually it's the same chart, but it's a bar chart or a candle chart, and it's got a trend line on it to basically give you an indication of the current uptrend that's been in place since 2009. Now, the key resistance level that we broke through earlier this year was around about 1775. Now, we're well above that at the moment. For the current uptrend to actually start to show any signs of breaking down, we actually need to break below that key support level around about 1775. So that's really the key level that I'm identifying on a fairly medium-term basis to give you some sort of inclination, if you like, that the current uptrend could actually be in danger of maybe a bit of a correction lower. Okay, so let's move on to the German DAX, and again that's been hitting record highs, and again this is a 10-year weekly chart. It's a simple line chart with the 200-week moving average. And once again, as in the case of the S&P 500, we can see straight away that the price action is quite some distance away from the 200-week moving average. But what's interesting here, in stark contrast to the S&P 500, is that the price action is actually nearer to the 200-week moving average than it was in 2007. Not by an awful lot, it's still nearly 2,000 points away, but that does seem to suggest that there may be potential for further upside in the DAX. But having said that, given how closely correlated equity markets are, if we've seen a near-term top in the S&P 500, the odds are likely that we could well see a near-term top in the DAX as well. So certainly worth keeping an eye on that. The DAX and the S&P 500, they're an awful long way from their 200-week moving averages, and generally in technical analysis at some point that disconnect or disparity eventually has to come back into balance. Now, how that comes back into balance, it can happen in any number of ways. You can either see a sharp fall in the price, or you can just see the price trade sideways for an extended length of time. So we've looked at the DAX, we've looked at the S&P 500. Given the fact that I was in Australia last week, I thought I would look at the ASX 200. And the ASX 200 is currently nearing a very key support level on this candle chart that you've got in front of you right now. And it's round about the 53.20 area. Now, for the past few weeks, it's been trading a little bit sideways, but with a slightly downward bias. Now, we can see from this chart, if we break below the 53.20 area, then we could well break a little bit lower and head towards the 5,200 level, which is trendline support from the August lows. So really need to keep an eye on that key level at 53.20. If we break below that and sustain a break below that, then we could well see a further down move towards 5,200. Okay, so that's really it for this week. I really just wanted to touch upon the fact that, Matt and I have been having a discussion about whether or not the current equity market rally is overextended or whether it's got room to go. Hopefully the charts that I've shown you will give you some food for thought. Bearing in mind that generally in the past few weeks of any calendar year, we generally get what is called a Santa Claus rally. So the question really is, given the gains that we've seen so far this year in equity markets, and I actually can show you a quick graphic of that, of the year-to-date gains for the S&P 500, the FTSE 100, the German DAX, to give you an indication of how each markets have outperformed each other. I think it's generally a useful exercise to see whether or not there's any more further, or there's any more scope for further gains, or whether or not we're going to see a pullback. Anyway, as I say, that's it for me this week. I do have a client event later this week. I'll be speaking at Bloomberg offices and it's an event for CMC clients. And I'll be basically going into a bit more detail of what I've really discussed in this video today. A look ahead to what to expect from the ECB, Federal Reserve and the Bank of England, and what effect any policy moves they will have on markets going forward. That's it for me this week. Thanks very much. This is Michael Hewson talking to you from CMC Markets.